Hi, everyone. Just here today with Don Nishio, who is with Manning LLP in Vancouver, and he's been a trusted tax advisor of mine for a long time, and he's helped a lot of my clients with their needs in Whistler, mostly with respect to non-resident properties and how that affects you if you're from the States or abroad. And of course, Don, I'm sure you can speak to this. Non-resident obviously means out of Canada, not a resident of Canada. So anyways, Don, why don't you go ahead and tell us a little bit about yourself?
Okay, first of all, I've been around for quite a few years. I guess I've been a CA for about 40 years now. I first started skiing in Whistler in 1970, so I would be an old timer. But I've never lived in Whistler. I live in Vancouver, and so we have a place in Vancouver. We've had it for about 25 years. So I get up there fairly often for skiing in the winter and golfing in the summer. So we really enjoy Whistler, but I do keep in touch with what's going on in Whistler. I know a lot of people in Whistler, and you know, the advising non-resident investors is kind of tied in to my interest in Whistler. So it's been a good combination.
Yeah.
I lived in Japan in the early 1980s, and I learned Japanese as a second language. And when I came back to Canada in 1985, shortly thereafter, there was, you might remember, a huge boom of Japanese investment all over the world where they were buying anything and everything. And so in the late 80s, got involved with a lot of Japanese investors buying hotels, condominiums, golf courses, anything. They just arrived with suitcases full of cash and bought. That was kind of my introduction to non-resident investment in real estate, and I've just continued with that for all these years. So it's, you know, it was a good, strong background, a good place to start, and then I continue providing that advice. Probably over the years, I'm guessing over 1,000 non-resident clients I've had that we've advised, help them with their tax returns. We help them with setting up the structure at the beginning, and then all the way up to the sale of the property and all the tax work that goes with the sale of the property.
Yeah, and you're busy right now. It's obviously tax season for you guys. Yeah. Well, thanks for taking a few minutes with us. Now, with respect to non-resident Whistler property owners, is there a little bit of a difference between that and the work that you might do with a resident?
Right. The short answer is working with non-residents is a lot simpler. And the reason is because we only look at the one or two properties that they have, and we just deal with the tax issues with respect to those one or two properties. In comparison, if you're dealing with a resident of Canada, then you have to worry about all their other tax issues, the tax situation. Do they have a small business? Are they registered for GST for their other businesses? What other investments do they have? So we have to look at the entire picture when we're dealing with a resident, where when we're dealing with a non-resident, it's really just their investment in Canada that we worry about. Anything that they're doing overseas is irrelevant for our point of view. And I'll give you a couple of examples of that. One is in Canada, we have what is something called a reasonable expectation of profit rule. And so with respect to real estate, one of the issues is if you have huge losses in a real estate investment property, can you write off those losses against your other income, your employment income, another small business that you have, whatever. And so CRA has this reasonable expectation of profit rule that says, if there's no chance of you ever making any profit on this investment, then we're not going to allow you to write off the losses against your other income. So with a resident, we have to concern ourselves about that. If they're a non-resident, then we don't care. The loss doesn't mean anything. It doesn't go anywhere from a Canadian point of view. It just falls off the table. So we don't have to be nearly as stringent and looking at all the different rules and the implications for a non-resident as we do for a resident. Another example, and I'll talk to this later, is for GST purposes, there's a whole set of rules regarding personal use. And it's kind of this formula of personal use and nightly rentals for the typical case in Whistler. So for a non-resident, most of the time they use a property manager. They're only here for maybe 2 to 4 weeks a year. It's all recorded by the property manager how many nights they're here. It's recorded by the property manager how many nights they rented. So that's very easy to get that information. If you could imagine a Canadian resident, typically somebody in Vancouver, has a property that they may rent out from time to time at Whistler. They typically manage it themselves, so there's no records of how many nights they use it. They can come up with a guess, oh yeah, they were there 4 or 5 weeks this year. There's really not hard records on how many nights they rented it out. And sometimes they let a friend use it, sometimes they'll take $100 there, $100 there. And so it's very, very unclear and subject to all sorts of, from CRA's point of view, abuse. And so that makes it much more difficult for us as accountants because we're trying to advise based on information which is not always very clear.
Yeah.
Those are two fairly major examples of the difference between a resident and a non-resident.
Well, when we flip over to the GST side of things, that's where things get kind of muddy for us. I mean, we deal with, you know, a unit over at Glacier's Reach, and if the buyer wants to use it for, you know, a few weeks a year and the rest of the time rent it, you know, he's trying to sort out what the previous use was. Can you explain a little bit about, you know, how that changes, the use changes?
Right. Well, in Whistler, which I think is unusual across Canada, I even heard CRA mention that Whistler is an unusual community. In mixed use is fairly normal. And by mixed use, I mean a combination of personal use, nightly rental, and there may even be monthly rental in there. GST is fairly straightforward if you only have one use. So the most common, I don't know what the most common, but an easy example would be you just buy it for personal use. You never rent it out either monthly or nightly. And so typically, if you bought it as what is called a used residential. So used residential property means the GST has already been paid by the original owner. When he sells it on to you and you're going to use it for personal use only, there's no GST because it's already been paid and you happily use it for 5, 10, 15 years. And when you sell it, there's no GST because it's already been paid. So that's a really easy example.
Just like if you own something in Vancouver and it's
correct.
just a residential place. Yeah.
The other relatively easy example is when it's rented monthly. And so monthly rental is not GSTable. So you wouldn't register for GST. You would typically buy a used residential property. So the GST has already been paid. If you're renting it monthly, you don't have to register for GST. You don't charge GST on your monthly rentals. And when you sell it, you don't have to charge GST on the sale of the property. So again, very easy to handle from a GST point of view. With nightly rentals, and I'm going to assume that the previous owner also had nightly rentals, the GST would have been deferred. So as long as the vendor is registered for GST, when they sell it to somebody who is also registered, so the new owner has to register for GST, then that GST gets deferred. And the new owner would register for GST, then presuming they rent it out on a nightly basis, they charge GST on their nightly rentals. They can claim GST input tax credits on all their expenses. They file GST returns. And then when they sell it, they charge GST on it. But if the next owner is also registered for GST, then it gets deferred again. So that's relatively clean. The problem is when you get switching back and forth, which is called a change of use, or when you have mixed use. And the mixed use, CRA came out with a technical memo. This is probably 10, 15 years ago. And they came up with this rule that says, we want to know your personal use percentage. And the other side of that would be the business use percentage. Until that time, most people thought the personal use percentage is per days divided by 365. So if I used it for 30 days in a year, and there's 365 days in a year, then you know, 10%. And there are specific GST rules. If your personal use percentage is less than 10%, then you really don't have to worry about GST a lot. Well, CRA came along with their great wisdom with this technical memo and said, no, that's not the way you count personal use. You take your numbers that you've used it as the numerator in this formula. The denominator in the formula is going to be your personal use days plus rented days. So just as an example, if you use it 50 days and you rent it out for 150, then 50 is your numerator, your denominator is 50 plus 150, and so you get with a 25% personal use percentage. All of a sudden you're above that 10% rule that is in the CRA legislation, and you can no longer claim all of the GST deferral or input tax credit on your purchase, on the supplies that you pay for while you're owning it. So it kind of mixes up the whole, all the calculations and all the returns that we have to do for the period of ownership, right? And then the other practical problem is it fluctuates every year. So you have people, and particularly our clients who are coming from overseas, they may come over for 4 weeks one year, but for whatever reason, not come the next year. So you can have your fluctuation going from 30% to zero, back to 30%, back to zero. And we've never heard of it, but in theory, CRA could come in and say, you owe us money, we'll give it back to you. You owe us money, we give it back to you every time there's a change of use. We've actually never seen that, but in theory, it could happen. So we more look at the long-term point of view, but that is not necessarily in the legislation, right?
Yeah.
And
so what's
go ahead.
I was just going to say, if we have a buyer that's looking for a property, I think the biggest thing that they need to watch out for is what that previous use was versus what they plan to do, right?
Right. Yeah, that's important, and whether they should be registered when they purchase it, and what is their good use going to be. So that's when we have new clients, one of the questions is, well, how do you plan to use the property? If it's going to be mixed use, what are going to be the ratios? And it's just a guessing game because nobody knows exactly what's going to happen in the future, but we can only advise based on what our clients tell us. So we can say, under this scenario, this is what should be done, but if it changes, then let us know.
Well, surprisingly, in a lot of cases, buyers that I work with, they don't necessarily want to even do rentals. Some people just don't want someone living in their place or staying there or in their bed at all. And so they just elect to just straight up pay the GST if it's been being commercially used and being rented predominantly. They'll just change that use completely and pay it. Yeah. It does happen. Not everyone wants to Airbnb everything all the time.
Mm-hmm.
Yeah. Well, when we move over to non-resident tax, can you just give us a brief explanation of that and how that works for someone who owns a property in Whistler?
Right. When you say tax, and there's many different kinds of tax. So we talked a little bit about GST. There's also income tax. Those would be the two main ones that we deal with, and I can go through that in a bit. There's also property purchase tax. There's annual property taxes. There's provincial sales tax, which includes hotel tax, and they all have implications at Whistler. I should mention too, and I'm sure that you're constantly being asked this. In Vancouver, we have BC speculation tax. We have an empty homes tax. You're lucky in Whistler because those don't apply. There's no speculation tax in Whistler. There's no empty homes tax. And even there's an additional property purchase tax of an additional 20% for non-residents in Vancouver. And you're lucky in Whistler, that doesn't apply. So it's just the basic property purchase tax, which is 1% on the first 200,000 and 2% on 200 to 2 million, 3% over 2 million, 3 million, and 5% over that. So compared to 20%, there were still relatively low amounts, right?
Well, we get asked that a lot, and a lot of buyers, they've heard of the non-resident tax, and they think that it's or sorry, foreign buyers tax, and they think that it's applicable up in Whistler, and it's not. So that's good.
Anyway, back to income tax. So that's the main tax that we deal with. Obviously, if a property is not rented, there's no income tax in the period that they just use it for personal use, but there would be tax when they sell it at the end. And very quickly, the tax on the gain. Canada is leery of non-residents. They want to get as much tax in advance as possible. So there's 3 stages of taxation for a non-resident selling property. But at the end of the day, they would pay up to a maximum of about 25%. So it's half of the gain is taxable, and the maximum tax rate here is 50%. So that would be the maximum income tax would be about 25%. And it's progressive rate, similar to the United States. So it could be less than that also, depending on the amount of the gain. If you rent the property, then you have income tax returns to file every year. But as I said, CRA wants their taxes in advance. So they have a rule that withholding tax of 25% of the gross rents have to be paid to CRA every month. Then at the end of the year, you would file a tax return and would, in virtually all cases, get a refund. So your tax return would calculate the net income on your rental property. So after deduction of interest expense, property taxes, management fees, strata fees, all those different repairs and maintenance, all those different costs. So oftentimes it's low or nil net income, and that withholding tax you will get back. There is an option to reduce that by if you have a property manager, which for tax purposes we call an agent. If you and the agent file a form called an NR6, you can reduce your monthly withholding taxes. All that does is it improves your cash flow. It's not going to improve the taxes at the end of the day. You still have to file a tax return. So the net taxes at the end is the same, but it helps your cash. Then the other unusual situation at Whistler is there's something called business income. And there's a number of hotels in town that if you bought a unit at a hotel, and this is one of the hotels that is approved by CRA to treat the income as business income, then that is taxed. The end of the day, taxes are about the same, but they don't have the same withholding tax rules. And they actually, they're similar to a Canadian where they would get into paying tax installments, quarterly tax installments, again, depending on the amounts. So there's those 3 different ways that it could be taxed in Canada. And we actually have pamphlets on each of those that we send out to potential clients on a regular basis. So that's the income tax. The GST we've talked about, 5%. We also have PST here, which is provincial sales tax. You would pay that on furniture, fixtures, anything in improvements that you're doing to your property. There's also hotel tax, which is a part of provincial sales tax, which is charged on virtually all nightly rentals. And it is actually increasing. The Airbnbs and those places are now having to charge hotel tax. And it includes in Whistler, don't ask me what the acronym stands for, but MRDT. So an additional 3% on top of the hotel tax. So your hotel tax is 8%, your MRDT is 3%. So you're paying 11% when you stay for a night at Whistler in virtually all, right? So those are the main taxes, I think, that any investor would have to worry about.
Great. Now, you do have pamphlets that you've been providing to us in digital and paper form over the years. So what I'm going to do is, along with this video and podcast, I'm going to put a link to those so that people can take a look at that. And I believe you do have your latest one. So thanks for that. And if anyone wants to get in touch with you, what's the best way to reach you?
So email is probably the best. So my email address, the name of our firm is Manning Elliott. So I'm Don Nishio, so it's dnishiyo@manningelliott.com. So MANNINGELLIOTT.com, and spelling my name D Nishio, NISHIO.
Perfect. And I'll make sure all that info is down below here as well. Okay,
great.
That's awesome. Yeah, appreciate it, Don. Thanks so much. Good to talk to you again.
Okay, look forward to enjoying some skiing in the not too distant future.
We got to make up for what we
Appropriately
lost this spring.
Right.
Okay.
Okay.
Take care, Don. Thanks.